Good morning, viewers. I'm Kusum from Manjeet Singh CPA PC in Falls Church, and with me here is Mr. Manjeet Singh himself. Good morning, Mr. Singh.
Good morning, Kusum.
How are you?
I'm doing great, and today we're going to ask Kusum some questions with respect to, as we are getting more and more income, what items can we use to reduce our taxable liability? Most of the question that I had is, or I was mostly talking about is, put your money in 401k plan. Put your money in 401k plan. So somebody said, you just keep saying that. So Kusum, I want you to tell us, the viewers today, what other options they have in terms of flexible spending accounts.
Sure. But you should continue to put your money in your 401k. It doesn't matter that the 401k is now pretty close to decimated. The markets will come back, hopefully. But yes, flex spending accounts, when your employer offers them, is a very good option. And what it involves is designating a certain sum of money, and you get only one chance to do it in the year, and usually it's in the beginning of the year, and you have to designate a certain sum of money which you are then going to use towards your, for example, your co-pays, your prescription glasses, your dentures, your hearing aids, things that your insurance will not directly pay for. And while on the subject, I might also add that if your employer does offer dependent care benefits, then you would go ahead and make the election to use that as well if you have children who require daycare. The maximum amount that you can put into that account is $5,000, but your flex spending account depends on what you are going to actually use. You have to sort of estimate what your liability for the year in terms of your co-pays and so on would be. And if you have a high deductible, then you know, and you usually go over that amount, then you would want to put the most into that so that you get the maximum benefit out of it. The advantage is that this money is not, in addition to not being subject to income tax, is also not subject to payroll taxes, which would be your Social Security and your Medicare, and therefore the savings are significant. However, it is a use it or lose it deal, and therefore if you overestimate and set aside a larger sum of money than you can use, then in the end of the year you're kind of scrambling to find things to buy so that you don't lose your designated sum.
Can I please add 2 cents of my thoughts on dependent care benefit?
Sure.
If you have one child, you are able to put $5,000 away for the care of one child. If you do not take the benefit of the dependent care benefit, you are allowed to deduct only $3,000. So you see, there's the advantage, clear advantage, that you're going to be putting away $5,000 pre-tax dollars. That means if you're in a 25% tax bracket, you did not pay tax on 25% of $5,000 is $1,250, $1,250. If you take the tax credit instead, that's $3,000 times 20%, $600. You come out ahead. Similarly, for 2 children, unfortunately, is still $5,000 in defined benefit credit or care credit. However, the tax saving still is marginally higher than claiming the tax credit.
Well, it is higher also because you don't have to pay payroll taxes on the amount, and that there is about $600 or so.
Hey, I forgot that one. All right. For further information, you are welcome to visit the IRS website, and we will take up some new topics next time we see you. This is Manjeet.
And I'm Kusum. Until next week, goodbye.